a good way to predict the presidential election is using the stock market. It kind of makes sense. If the stock market's doing well, that tends to be correlated to the economy doing well. So people getting paid more, feeling more secure in their jobs, their communities doing better. In general, things going well. Yes, that's a simplification. Say in the UK, I think 70% of the profits made by companies in the FTSE are abroad. So it's more a gauge of how the global economy is doing rather than locally. But I can see the idea, the reason why it makes sense. Why I'd have a look to see whether there's any relationship between how the stock market's doing and how elections have done. And on Bloomberg, they had this fascinating article where they've already done the work for us. And basically, the S&P 500 has correctly predicted 19 of 22 elections since 1928. And that to me is significant. Now, it is complicated. So we have looked at how, in this recent period, companies have been borrowing money since interest rates are low to buy back their own shares. So share prices are kind of obscuring reality. Previously, maybe companies were owned more by the general public, so people would be more invested in the stock market and their mood would be reflecting what was happening in the market. So if the markets were going really high, people in general would be going, oh, it's great, because they were all making money. I don't know whether that's as much the case now. So here it is, 19 out of 22 times, so that's great. When stocks are higher in the months before a vote, the sitting party has won 86% of the time. Okay. Now, the problem for me with this is when? By how much? I mean, how many months? Basically, how much higher does it have to be? So, is it if the price is below the 200-day moving average, then things are bad, and so the government gets whacked? So, after the banking crisis, share prices would be below the 200-day, and the Republicans got whacked. I don't know. I mean, unless it's more well defined, it's not actionable for me. I mean, I can't bet on that basis. I can't predict on that basis. Now, I know that the stock markets are at record levels at the moment, though it does say when stocks are higher in the months before a vote. So, in a way, we're not yet in the relevant period. So in a way, the fact that the stock markets are at record highs is dangerous, because the only way is down. Perhaps. What makes this article even better is it gives us actual numbers. So it's not being vague and obscure. So this tells me that if it's just higher or lower, it doesn't matter whether it's gone up by 20%, 10%, even at just 0.1 lower, correctly called it. So all we need is to see what happened in the months before the election, and this called it very well. Now, I still don't know what is the time period, but I've got exact numbers. So I can look over, say, historical data and reverse engineer. I can look at what the share price was on the day of the election, see how far I have to go back for the share price to be 2.5 lower. So, this is all I need. But it's even better than that. It even mentions based on 3-month return prior to election day. So fantastic. We know what the rules are. We know coming up to the election day what the prediction is. We can go on the election day, we just go back 3 months, see whether the markets have gone up or down, and then this prediction engine, which has been back tested, so it's got some history. This method will then give a prediction. So that's our candidate one, and basically looks better than, just say the betting market, and a good place to start. If you know any other methods, please comment below, because it'd be just handy to kind of gather the various different approaches, and then we can make a decision ourselves. Thanks.